When you see it turning up, how many times do you see it turn up and then turn immediately back down? Not very many. It's one of those things where it's almost like, the snowball effect as it's going down a mountain, just keeps getting bigger and bigger. It's really hard just because it's low. Yeah, it was low here in 2007. What happened? It went up a lot higher as the economy continued to spiral down. Hello and welcome everyone to this weekly market recap for the week ending August 2nd, 2024. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host here for this show for the next, hopefully next 30 minutes or so. Try not to keep you too long. I do want to go through first some of the key, at least some of the key things came out of last week for me. Number one, obviously, we had a big Fed meeting. Meeting started on Tuesday. It culminated on Wednesday at 2 p.m. with the Fed statement. I'm still shaking my head here, 4 days later. I don't really understand what type of message the Fed is trying to send. And I think as I go through a lot of these charts, maybe you'll agree with me, maybe you'll disagree. Feel free to leave comments. Love to hear what everyone else has to say. But it looked to me like things were kind of left somewhat unfinished after the Fed meeting. And so let me go ahead and start and go through this stuff. So here was the wording from the latest Fed statement I've put up on your screen. Now, anything, if you've seen this before, anything that is red and lined through was wording from the prior policy statement that's been removed in this one. If you have red wording that's been underlined, that's wording that's been added in this policy statement that was not in the prior one. So as I go through, the first thing I'm going to say is this last line of the second paragraph was probably the most important, although some of the others I really didn't understand. But let's talk about this last sentence here. So what was previously in this policy statement was the economic outlook is uncertain, and the committee remains highly attentive to inflation risks. That's what was in the prior one. Now, in the current one, they switched it. They said the economic outlook is uncertain. That didn't change. And the committee is attentive to the risks to both sides of its dual mandate. So one side of its mandate is to stabilize prices. That's the inflation side that they talked about in the prior meeting. In the current meeting, they're now saying that we have risks on both sides. The other side of the mandate is to maximize employment. So we're talking about the economy. Well, they acknowledged that we've now got economic problems here. And if you look up above, job gains prior was remained strong. Now it's moderated. So they're recognizing that the jobs gains, maybe there's a little problem there. The unemployment rate has, instead of remained low, moved up, but remains low. So now they're showing you the unemployment rates jumping. They recognize that. Job gains have moderated. And we just saw on Friday, we had a big jobs report, and they're moderating all right. And then they go on to say inflation has eased over the past year, but remains somewhat elevated. So they're recognizing all of the stuff that we need to see to lower interest rates. So it's basically, like a gourmet chef fixing you dinner, and you're sitting at the table salivating, and then they throw you dinner in the trash can because the Fed did nothing. Okay, yeah, the economy is weakening. We see that. Yep, inflation, it's elevated, but it's continued to ease. This is exactly what they want. Well, maybe not the economic weakness, but this is what they needed to see in order to lower rates. They didn't lower rates. I mean, you can't make this stuff up. And they're worried about inflation still. I mean, I'll show you an inflation chart in just a second, but I don't see the need to continue to fight inflation at this point. They had a perfect opportunity to lower rates. They should have lowered rates at this meeting. They've now put on the table the idea of maybe a rate cut, maybe a rate cut in September. I can tell you right now, folks, the market had a September cut priced in. And I think the market was looking for the Fed to give pretty much overwhelming confidence that a rate cut was coming in September. And I think the Fed walked away from this meeting still leaving the market wondering. And we're seeing more and more economic deterioration. But anyway, I wanted to start with this because I thought this was the most important thing that came out of the week. The Fed now acknowledging the weakness that I've been talking about for a while. Some others have been, talking about it a bit. Now the Fed is acknowledging it and still refusing to do anything about it. Let's take a look at this inflation chart. So the Fed, by their own admission, they're waiting for a sustained move in inflation toward 2%, a sustained move. Now, I'm looking at this chart, and the bottom panel is the annual rate of core inflation. And you can see that since, September of 2022, we're talking 2 years now. Since then, we have gone down just about every single month in this annual inflation rate from 6.7% to 3.2, whatever the number was, 28? Yeah, 3.28%. Here's the 2% target level. What is considered, I don't know what is considered a sustainable move anymore. What is a sustainable move? If 6.7% down to 3.28% is not a sustainable move down toward 2% target, I don't know what is. I mean, seriously, leave me a comment. What do you think? What do you think that a sustainable move means? Does it mean getting to 2%? Because that's about the only thing we haven't done. Anyhow, you can see that the monthly readings have continued to come down. They're volatile. They've jumped up and down. But if you go back over most of this century, the 1 month rate on the inflation has been somewhere between 0 and about 0.3, 0.35. Almost every reading has been in that range. Since, I would say, maybe June of 2023, we've had essentially just about every reading. We had maybe one or two that were, at the top end, maybe just slightly outside what I would consider a normal range. But, I mean, we're talking about now, 15 months of data, 14 or 15 months of data. And I mean, the move to the downside over the last 4 months has been remarkable. Very, very fast, down into a range where it certainly appears like inflation's now pretty well contained. Apparently, it's not enough. So let's take a look at the unemployment rate. Hey, I've been talking about this. Finally, the Fed mentioned it in their, policy statement, but this didn't just start. The unemployment rate, yeah, it's been low, but it's been mostly rising since the middle part of 2023. This isn't something that just happened. That jump that we saw on Friday in the unemployment rate from 4.1% to 4.3%, that is a big jump in the unemployment rate. I mean, if you start talking about economic weakness building, there's nothing that starts it or that would, produce or provide more confidence that things are slowing than to see an unemployment rate jumping. More and more people are losing their jobs. They're out of work. That is going to have a direct impact on economic activity. So you see this, and then over here on initial jobless claims, I've talked about this, talked about how the initial jobless claims have been rising. The unemployment rate started moving up a year ago. Initial jobless claims have really started to pick up here in 2024. Now, this is a weekly report, so it's, a little volatile up and down, but I don't think I think it's pretty clear that we've got a trend to the upside in initial jobless claims. I mean, these are people filing initial jobless claims for the first time. That number's on the rise. We're not far from reaching probably what would be about almost a 3-year low, or 3-year high, up around that 260, 265 level. 249 was the reading on Thursday. So continues to jump. Look at the 13-week initial jobless claims. So this is for a quarter. Look at where we are right now versus, just the look back. This is the rate of change over the last 13 weeks. Highest level we've seen in the last 5 years. I could go back further. Actually, why don't I? Let's just go back further. See. Actually, it's not letting me go back further. I don't know why it's, oh, here we go. Let's move this back to, we'll go back to 2010. I mean, all right, so there was that. Now that's probably why I showed it on a 5-year chart, because this makes it really difficult because of what we saw in the pandemic. All right, so never mind. Let's stick with the 2020. But still, I mean, we're talking about 5 years. This is the highest 13-week rate of change that we've seen in 5 years. It's heading in the wrong direction, folks. Unemployment's heading in the wrong direction. And now we've got a Fed that's finally recognizing it. Finally. I mean, that's, again, why I said we've had economic weakness that's been building. We've had cracks in the foundation. I've talked about this over and over and over again. Finally, the Fed sees it and then does nothing about it. So if you want to know what happened to the stock market last week, what I think happened is we saw a lot of, what's the right word? Lack. I mean, well, it's definitely lack of confidence in the Fed by our financial markets. That's the way I interpreted last week. I don't think there's a whole lot of people out there who are big fans of Fed Chief Powell anyway, but this may have just sealed the deal. And so market asked no questions last week. It just sold. So let's take a look at the 10-year Treasury yield. So here's the bond market. So the bond market goes up and yields go down generally for two reasons. One, if inflation is getting under control, that's when you want to get back into bonds, because as the inflation rate comes down, you're earning more real interest. So folks will buy into bonds, which sends the yield lower. The second thing that will send bonds up is a weakening economy. So when the economy weakens, folks jump into bonds because they anticipate that rates are going to go lower. And when rates go lower, bond prices go up. So if you buy bonds when they're yielding 4.5%, your bond prices go up tremendously when yields move down to 3.79%, which is where we finished on Friday. 3.7. I don't know if I said 3.9 or 3.79, but finished at 3.79%, which was right down at that December low. So we're now threatening to break to a new low on the 10-year Treasury yield, lowest low that we've seen since back maybe just a little over a year ago. Anyway, let's keep going. How about the volatility index from last week? I mean, volatility, when that VIX gets over 20, listen, I don't argue with anything. When that VIX is over 20, that is telling you market makers are basically responsible for the VIX. They're looking at pricing the options, the spread and so forth that's on those short-term options. And so when the VIX moves up, it's an expected volatility index. So when the VIX is rising, it's telling us that it's expecting more volatility in the market over the next month. Well, if you know anything about volatility, you know volatility spikes when markets go down. And so when you see the VIX rise and it gets above 20, history tells us you do not want to be, just humming along thinking everything is, just okay in the stock market when you're getting VIX readings above 20. So there's a warning sign right there. Now, we've been talking about a lot of warning signs of late, over the last couple of weeks in particular. But this is one that basically beats you over the head, that now, okay, the impulsive selling has begun to kick in. People start, when you start a slide like this, sometimes they can get really out of hand very quickly. And the market's not rational. It's not saying, well, let me think about the valuation on these companies. No, it's sell, 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 and worry about it later. Figure all that other stuff out later. Sell first. And that's what we saw at the end of last week. Just straight down moves. That is panicked selling. And we saw that with the VIX rising as high as 29.66, almost got to 30 before settling down and closing above 23. That is not good news for the stock market.
If you're liking the video so far, please consider liking and subscribing to our channel. Thanks again for watching.
I mean, if you look at where the VIX was in 2022, this was the cyclical bear market. The VIX never went down below 17, and it stayed elevated and was anywhere from about 17 to 40 for the entire move to the downside. So anytime you got a VIX up in the, above 17, but especially above 20, that's when I worry about the stock market. Now, on the other side, if you're going to be in a bear market, and I don't think this is a bear market, it's definitely a correction. I'm not ready to go bear market just yet, although the Fed may have just, maybe written the script for us. I don't know. We'll have to continue to watch it. But I do believe that we're going to see 10% across the board. We already saw it on the NASDAQ, by the way. S&P 500 is not that far behind, probably a few more percent to go. But if the VIX were to drop back down below 17 for a few days, that would make me feel a lot better about maybe the longer term of what we might see. But if we stay above 17, if our dip in the VIX is back to 18 or 19, and then we go right back up into the mid 20s, that is not a good sign. So watch the VIX. The dollar. All right. So dollar, I've been thinking, hey, the dollar is going to be strong. We're going to continue to have a strengthening dollar. Check out what happened. There's maybe a crack in the confidence in the dollar on Friday. You can see what happened. Big move down in the dollar. You don't see these kinds of moves often. And as well, took out lows that we had seen back over the last 4 months or so. So this is the weakest the dollar's been in a while. And again, I mean, if you're thinking the economy is going to weaken, chances are you're going to see a little bit of weakness in the dollar as well. So one other thing to keep in mind, the dollar moving down. All of this, leads to a couple of potential areas of interest as far as investing. And I've got my weekly market report coming up on Monday, and I'm really going to dive into some of that. So I'm going to save it for there. But yeah, the fact that the dollar's going down right now, not a great sign for equities. Again, I think it's a little bit of some confidence lost in the Fed, that they maybe lost control here. They've kept rates up too high, too long, and now we're seeing the effects. And it is hard. Look, I'm going to go back and show you that unemployment rate. When you see it turning up, how many times do you see it turn up and then turn immediately back down? Not very many. It's one of those things where it's almost like, the snowball effect. As it's going down a mountain, just keeps getting bigger and bigger. It's really hard just because it's low. Yeah, it was low here in 2007. What happened? It went up a lot higher as the economy continued to spiral down. How about 2000? Yeah, it was low when it started spiking then. What happened afterwards? How about 1989, before we had 1990, before we got into the Persian Gulf War and the recession there? Yeah, it was low. Well, at least back then it was low on a relative basis, but it got a lot higher. Same thing for back in 79 into 80. When we had those two recessions at the beginning of the 80s. So I don't see anywhere on this chart where you have this kind of a move to the upside in unemployment. It just stops and goes away. That's a problem. And I think the Fed had an opportunity here over the last few months, had they started cutting sooner, to maybe stave this off. Now, if inflation takes off and they turned out to be right about inflation, then I will offer up my apologies, and we'll move on. But if I'm right and inflation is completely under control, then what we're seeing by this Fed has been completely irresponsible. All right, let's look at some of the areas of the market. So we know what happened. We had the Fed statement come out. We know the Fed now has acknowledged that we're weakening, still not willing to do anything about it, but saying, hey, yeah, things have gotten weaker. Sorry, we're going to keep fighting inflation. Well, last week, a lot changed in the market. We had seen the fact that small caps had taken off to the upside. And this was in anticipation. This happened earlier this year too, by the way. Or maybe it was, I think it was earlier this year, and then maybe once late last fall, early winter or whatever. in November, December, where we got movement to the upside in the small caps. Small caps are going to react positively if rates do come down, if and when rates come down. And we've seen that as the market has begun to anticipate rates coming down. And then the small caps fall right back off the table because the Fed doesn't follow through. Well, that's exactly what happened last week. I mean, here's the Russell 2000. The Russell 2000 over a 2-week and 2-day period, something like that, like 10 to 12 trading days, had outperformed the NASDAQ by 18 percentage points. That was the market going all in on the Fed acknowledging the weakness and vowing to cut rates. This week, especially after, it wasn't all week long, it was Wednesday at 3 o'clock, an hour after the Fed meeting, that the small caps absolutely fell apart, dropping 6.79%. We were at a high on Wednesday at 3 o'clock. I mean, we had gone up in small caps this week. So when you're thinking about the week, don't think that we were going down for 5 days. We went down for 2 days and an hour to the tune of 6.79%. And that was from the prior week's close. From Wednesday's 3 p.m. high, I think the IWM was down 10% or more. I'd have to look at the chart to see exactly, but I believe it was down about 10%. I think we hit a high of 228 and change, and we closed at 208.99. So roughly $20, maybe it was just under 10%. But that was just from 3 o'clock on Wednesday. XLK Technology, been the leader throughout the secular bull market, but I'll tell you, this is a group, I'm going to show you on an RRG chart just a second what's going on with technology, and it's not pretty. Mid caps, then you've got discretionary. So now you've got two of the biggest aggressive areas of the market. A lot of the growth stocks in technology, in consumer discretionary. Those two groups, bad underperformance relative to the S&P 500. Even industrials and financials, remember, they were actually starting to build. We were seeing some real nice strength in the financials, thinking that, hey, we're going to get short-term rates to come down. Inflation's not a problem anymore, so the long-term rates will come down. This will be a nice environment for companies in the financial and industrial space. Nope. Turned around after Wednesday, took a nosedive, underperformed the S&P 500. What outperformed? Utilities, real estate, staples, and healthcare, 4 of the top 5 groups. Only communication services saw a gain last week. Only aggressive group that outperformed the S&P 500. And it wasn't by a lot. I mean, it's 3%. Actually, that is quite a bit. But communication services did well. But otherwise, it's all about defense. That's normally what happens when the market goes down, by the way. But there was some cracks in the foundation even here prior to that. Let's take a look at that relative rotation graph. So this is a chart where the S&P 500 is the benchmark. And what we see is how all of the sectors are performing relative to the S&P 500. Now, anytime you get, movement up into here, you're in the leading quadrant, which means you are above the center line in momentum and you're right of the center line in terms of relative strength. So that's the quadrant you want to be in. And this is where technology was on July 11th. Now, why am I pulling up July 11th? Well, that was the day that we saw the CPI report for June come out. Remember, it came in at less than 0.1% rise, which was the lowest monthly rate we had seen in a while. It brought the annual rate down to 3.28%, more toward the target. Money started to flock into small caps, into some of the cyclical areas that would benefit from the lower interest rates. But look at the technology group. Technology was just heading from weakening back into the leading quadrant. And I want to show you, that's the 12th. Right here, you can kind of follow along with the date as I drag this across. But there's the 15th, 16th. Now, I'm stopping there. Why is the 16th important? Because the 16th was the top on the S&P 500. This is when the S&P 500 topped. It wasn't, last week. We'd already come down some, and that had moved down. We had a little bit of a bounce. This was the day that it topped, July 16th. Look at the only two areas to the right, the only two areas at that point showing relative strength: consumer discretionary and technology. And all the folks talking about breadth and saying, that it's not enough breadth, not enough breadth. Well, you saw what happened when we got breadth. When actually we started seeing the other areas of the market outperform, we saw what happened. Those who were looking for breadth to lead this market, well, look at it as we went, through this downturn. There's your breadth. Now you got all these sectors. Everybody should be happy, right? Look at that breadth. I see 8 sectors, right? All in that leading quadrant. I've got communication services making a move back toward there. That would be 9 groups out of 11. Wait a minute. Stock market getting hit. Volatility went almost to 30. It's not always about breadth. That's why I don't even follow breadth. Now breadth readings, I'm sure, are probably looking a lot better, many of them, than because now you got all these other stocks that are outperforming the S&P 500. Now, as of Wednesday's close, let me pull that up. That would have been July 30th. This is where we stood. Or no, July 31st would have been Wednesday. Let me go one more day. There's July 31st. So on the 31st, we saw technology start to get a little bit of momentum back to the upside, still way left of this vertical line. So this is what marks relative strength. Technology was not doing very well. And then over the next 2 days, whoops, actually dragging the wrong thing here. Let's go back to that 5-day. Over the next 2 days, look at technology making a further move to the left, showing relative weakness when the market was going down. So in other words, technology driving the market lower. It had been driving the market to the upside. But hey, for those that were upset because technology was leading the market, well, you got your wish. There's technology. Now it's leading to the downside. And that really didn't help the market much, as you can see. That's what happens when a market cap weighted index is represented by one group to the tune of 32%, and that group doesn't do well. Now you got your breadth, but it doesn't matter. S&P 500 is going down anyway because of technology. Move on. Let's take a look at a couple of charts before we get out of here. S&P 500, clearly a breakdown below the recent low, now definitely below both moving averages. The PPO on the daily chart has turned negative. So now we've got more bearish momentum that is building in the market. Got to watch the 20-day moving average on any rally attempt. When you are in a downtrending market and the PPO is pointing lower like it is right now, it is making a beeline into negative territory and strengthening into negative territory. That's what I mean by when it's pointing lower. When anytime you've got this and you get a rebound, I don't expect it to last. If it does, that's a good sign technically. But if it fails at that 20 and turns lower again, that's just another sign that we are in for a very difficult period ahead. NASDAQ 100, similar, except here we've already seen the death cross. The 20 is crossed below the 50. And so now going back up and testing those moving averages like we did last week and failing, we went into the Fed meeting ready. All the Fed had to do was, some are in the camp thinking that, hey, if they had lowered rates, that would have been a spook to the market. I don't think it would have been a spook to the market. I think it would have been a claim of victory against inflation. The Fed's so confident about inflation that they're willing to lower interest rates. I personally think it would have sent a great message to the market. But anyway, we'll never know because they didn't cut. But we were in position for this just to be an April move, to the downside, a sell-off that didn't last very long and we could start to repair. I think what happened after Wednesday changed that thinking. And I would be very surprised at this point if we just rally back. What's going to cause it? The Fed, they don't meet again for 6 weeks. So there's nothing the Fed can do at this point except watch the economy continue to deteriorate. If inflation were to spike at the next reading, that would be just, I guess, nirvana for the bears. I mean, if you get a spiking inflation and economic weakness at the same time, if you get a little inflation coming back into the news, that's really going to make it difficult for the Fed to lower rates. If they're not lowering them now, they're certainly not going to lower them if we see a spike in some of the inflation readings. So I think if you're bullish the market and you're long, you're certainly hoping that inflation news continues to be very good news, which would lead the Fed to at least start cutting in September. If they don't cut in September, based on what I'm seeing with this economic weakness building, I think we are in for a very difficult end to 2024. Technology. So we just showed you how weak it is. We were talking about this one, bounced into the right shoulder of this head and shoulder top. I mean, there were plenty of warning signs. How about that bearish engulfing candle right at the high with a negative divergence? I mean, this is a textbook head and shoulders pattern. It broke the measurement. I said the target was 205. We closed on Friday at 204.75. That didn't take long. And that's just an initial target. That doesn't mean you get to the target and you go back to the upside. Head and shoulders pattern is a topping pattern. It could top and hit its initial measurement and be done, or this could be a long-term top. I mean, we could see the market go back down. We could see technology back to the April lows. I mean, that's at 192. If that doesn't hold, we got some problems. Look at the relative strength down here at the bottom on the XLK versus the S&P 500. So not good news. And also on this pullback, sometimes, we get pullbacks and the AD line doesn't really drop much here. We're definitely dropping. So we're going to need to see some accumulation in the days and weeks ahead. And I'll take it 1 week at a time, but I'm just telling you from where I'm standing right now. I just don't like the way things have set up. Here's the NASDAQ 100, and here were the worst performers last week in the NASDAQ 100. So I've got the period set to 1 week. And you can see, look at the list. I put sector and industry in here so you can see what is leading. Technology all the way down for the most part. Moderna had a horrible week. So that's healthcare. But then you got Booking, which lost 10%, discretionary, Marriott discretionary. But otherwise, this page is just littered with technology stocks, mostly semiconductors. Couple software, 3-4 software, a lot of semiconductors continuing to get absolutely pounded. That is not a good sign. When growth is out of favor, semiconductors, normally will get hit the hardest. It's because they go up the most. They have the ability to increase their earnings the fastest. I mean, just take one look at NVIDIA and how fast it was growing its earnings. So you can't price that with a multiple of 10 or 15. But the problem is when you reach a peak in economic activity and start rolling over, it's going to be difficult for these companies to continue to expand their earnings at prior rates if we morph into a recession or even into a period of economic slowdown. Doesn't even have to be a recession. That's why these stocks are being repriced so fast. But I've talked about the semiconductors over a month ago, said they topped back in mid-June. And now you're looking at the carnage that's followed. Not good. If there is good news, a lot of these companies are going to eventually hit levels that are going to be great prices to enter. But I think you got to let this play out for a little while. There's the semiconductor chart. There was your double top or almost double top. Here was the low in between, which was about 18.5 from 21,000. That's 2,500 points. When you break below that first low in a double top or the ultimate low between the double top, when you break that, you can tack on another 2,500 to the downside. That's the measurement. We were at 18.5. That takes us to 16,000. Well, on Friday, we hit a low of 15,790. So the measurement there's been made. But again, we're talking about an initial measurement. Maybe based on that, we'll have enough interest. We did see some buying in the afternoon on Friday. Maybe we'll get another bounce. But as bad as this daily PPO looks, anything close to that 20-day moving average, if I was in semiconductors, I'd get out of them. I want them to show me that they can make a breakout above that 20-day moving average. Until then, you've already seen 2 failures. Both of those failures were opportunities to get out. I see probably more weakness down the road over the next couple of months. I do not think we've seen the low yet on the semis. Last chart, I had to bring up IWM. This is a group that I was very, very bullish on this breakout. and this moved to the upside. It came on increasing volume. You can see the AD line soared, went back, looked like it was going to break to, its 5-year high here. And instead, we went sideways. We were fine. The sideways action didn't bother me. But on Wednesday, I'm going to show you a 5-day chart on the IWM, 5-day, 10-minute. Here was the Fed announcement. We kind of did nothing. Then all of a sudden, we made this big spike. And I was kind of scratching my head at that point. Based on what had happened and what the Fed said, I did not understand why anyone would get that excited to the upside, but that turned out to be the final straw. There's the 228 and change. And when I talk about pretty much straight down, there was your selling. I mean, this was a $10 sell-off. This is not gap downs. This was an absolute direct sell-off. That's a lot of distribution right there. Very heavy volume. Then we went sideways, and then Friday we gapped down and actually closed not far off the open. So if we continue to gap down like we did on Friday and not really see further sell-offs, that would start to be a sign of more accumulation. But we got work to do before we get there. Anyway, I hate to be the bearer of bad news, but I call it like I see it. If it's bullish, which I'm usually bullish, I will tout that bullish side. That's what the market usually does. I want to make sure that folks stay in and benefit from a rise in equity prices, especially U.S. equity prices. We've been talking about some short-term tops of late, talking about cracks in the foundation, and now we've got a Fed that basically is acknowledging all of that and doing nothing about it. Hard to get excited about that. So I think we've got further downside with some bounces along the way, but I think you really have to be careful, especially if you're trading from a long perspective, because some of the strength may not last very long. Remember also, we're in a presidential election year, and in that cycle, if you go back to 1950, August and September are the two worst months, or two of the worst months of the year every year, but especially during these presidential election years. So we've got the uncertainty of that political race that's still going to be developing right in front of our eyes, along with all of this economic uncertainty. And if there's one thing the stock market does not like, it's uncertainty. So please be careful. And also, while you're at it, like the video. Again, I'll give you both sides of the picture. I'll give you the bearish side when I think it's warranted, but I'm most of the time going to be bullish. I'm going to give the benefit of the doubt to the bulls because the market goes up more often than it goes down. But when it does go down, it shows the signs that it's been showing these last few weeks. I will talk about it, and I'll turn bearish when I need to turn bearish. But anyway, if you like these videos, please hit the like button and subscribe to our channel. That will certainly help us in our algorithm with YouTube and help us build this community here at Earnings Beats. It was a pleasure being with you again this weekend. Be careful next week. Like I said, hopefully we get a bounce, but I'm just kind of holding my breath heading into Monday's open. Have a great day, everybody. Happy trading.